Good morning,
Yeah.
Melissa. We usually do this at noon and it's usually afternoon by then. So really quick, I imagine this could be a pretty quick podcast here because things are happening, but not a lot. So this morning I did see the jobs report come out and it looks like we have added more jobs to, you
We
know,
have, which is amazing for the people that are employed, but it's it doesn't help the cause of lowering inflation. And like we are literally at the lowest, so we're at 3.4% unemployment, which is the lowest level since 1969, which is insanely good. And then also our average hourly wages increased 0.5% in April, which again is good. And I think if you look at long-term wages relative to inflation over a long period of time, this needs to happen. But it's just not good that it's happening right now as we're trying to bring inflation down. So
right, right,
there's definitely a pull and give and take there. So that's the downside. Now inflation numbers they are coming down. They just are not coming down as quickly as we would like. And there's concern that because the job numbers are so good, that trend is not going to continue on the inflation numbers. So that's really where this kind of hesitation comes from and why we are not seeing a rally in rates. The Federal Reserve did raise rates on Wednesday. They raised them 0.25 percentage point, which is exactly what we thought they were going to do. So no surprises there. And given that there were no surprises, we honestly thought mortgage rates would drop a little bit, but we've got this employment news. So we're probably going to stay where we are, which is in like I would say 6.25 to 6.5, maybe a little bit higher for some people, but that's basically the range that I think we just have to, it is what it is. It's what we're living with. And if you find a house you love or like, and you can afford the payment, it's still a great time to buy because it's a tight market. And if you can get under contract now, I think you're going to be better off than if you wait until when rates drop. And I've kind of heard a lot of news about that tipping point being 5.5. Like that's the number that people think they'd be comfortable with.
yep.
Now, we might be able to get you there with the buy down of the interest rate. So, I mean, again, almost anything's possible. So just
Right, so that's,
time.
yeah, so that's what I was just gonna touch on is that although the interest rate, on paper it says 6.25 or whatever, there are ways to get it down to, 5.5 or, I mean, how low can you go by buying down points, by buying down the interest rate?
It depends on the day. Usually lately it's been about 5.5. Getting below that gets to the point where you're paying so many discount points that you go into high cost. So a high cost loan, there are limits to the fees that you can have on a loan.
Yes.
Getting that, and then unless the seller's paying for those, which it's tough to negotiate in this market, it's kind of what we're stuck with.
And so by buying down the interest rate, say for a $500,000 house, if you spend what is it, about a 1.5% to buy down.
So 1% of the loan amount would be one discount point. Now it's not a 1-to-1 ratio of you pay one discount point, you get a 1 point reduction in interest rate. Unfortunately, the reduction you get is based on the market. So it might cost you 3 points or 3.5 or 4 points to get down to 5.5. So that's a big chunk of money. But what I always do with clients is look at, okay, how long do you think you'll keep this loan? And then look at what are your cost savings if you pay those discount points over that time period. And we'll look at no points, 1 point, 2 points, 3 discount points, and figure out based on how long you think you're living the house, that will determine which makes the most financial sense. Now, sometimes it can make the most financial sense to pay 0 or 1 discount point, so highest rate, but the person's really more comfortable paying the points and having a lower rate now. Then they just have to keep the house longer to break even, or keep that loan longer to break even. But ultimately, it's a decision that you want to be fully educated, but you want to make a decision you're comfortable with.
Right. So if you were to spend, okay, say you have to buy down 3 points and it's $15,000 for a $500,000 house to get to that 5.5%. So that's $15,000 up front, but you are going to save that in your monthly mortgage over, the next 10 years or whatever, not even the entire life of the loan. So that's great information. And the unfortunate thing is so many people see interest rate at 6.25 and, have no clue that or don't understand that there are options to get that interest rate lower, to lower your monthly payments. So what do you think about this? We all know 401ks are there for retirement.
Yes.
And I encourage, so part of your retirement is having a roof over your head, right?
Yeah.
And so a house here in the North Texas, well, a house period is an investment. And since we appreciate here, basically, as long as you keep your home up, maintained, your home will just appreciate year over year. And typically it's between 3 and 6% here in the North Texas area. So withdraw from your 401k, that 15 grand or whatever to add to the point buy down. So what do you think about that?
That can be a really good option. And I think people are often very fearful about pulling from their 401k, but if you look at the long-term difference between being a homeowner and a renter and the difference in net worth, you pull that money out every time, whether it's to buy the house or buy down the interest rate.
Yep.
And
I
so,
agree.
yeah, no, 100%.
Perfect. Okay. So we talked about the job market, the job report. We talked about, once again, buy downs. That's really, really important for people to understand. The interest rate doesn't necessarily need to be the interest rate that you get. There are ways.
I think that's good to understand too, for people who are shopping for a mortgage. If they see an interest rate online from bankrate.com, let's say, that interest rate is a real rate, but it's based on usually a 25% down payment, usually a large number of discount points, and a 780 or higher credit score. So it's like, if you fit that box and you have 25% to put down, yes, you can have that, but that rate is designed to just get you to click, get into their funnel, talk to someone in a call center who's not going to really give you the good advice that you need.
Good point.
Strategy. So, and know that if you're talking to a loan officer, a local loan officer like myself, you can have that rate. You can. It's just, we need to talk about putting 25% down and maybe bringing your score up to 780, and how many discount points is it going to take? But you can, and there are always options.
And that's why it's so important to also connect with a knowledgeable loan officer so that you can get all of the information you need to make an informed decision instead of just signing on the dotted line like a lot of people do.
Yeah.
Because there are ways around,
It doesn't always work.
ways around everything. We know that. So just really quickly, so are you guys seeing more mortgage applications coming in?
We are. Yeah, it is definitely the spring buying season.
Good. So that's, an incentive for sellers to, get off the fence and go ahead and get the home listed. And of course, buyers start getting your applications in ahead of time. They can, Melissa can do a soft pull on your credit. So it doesn't affect your credit score at all. So she can tell you where you need to be or what needs to be done, or this is what you qualify for. And, again, sellers, it's that time of year,
Yep.
let's get it sold. So if you have any questions at all, feel free to contact me for selling or even buying. And Melissa, of course, is knowledgeable and she can help you through the entire loan process. And you can contact her at, Melissa, go ahead and give your information.
214-535-6738.
Okay, well, thank you, Melissa, and you have a wonderful weekend and a great week next week.
Thank you. You too.